The Australian dollar attempted a rally earlier in the Asian session, but the upside was capped after the Reserve Bank of Australia delivered the rate cut by 25 base points to 3% as widely expected. Governor Glenn Stevens warned of a strong Australian dollar and stated that the near-term outlook for non-mining investment would remain relatively subdued. On the global economy, the Reserve Bank continued to see the key risk coming from the Eurozone's sovereign debt crisis. While acknowledging improved sentiment in financial markets, it is believed that Europe is likely to remain a source of instability for some time. Moreover, the central bank added this time that the uncertainty over the course of U.S. fiscal policy is also weighing on sentiment at present. Concerning domestic economic growth, the bank confirmed that resource investment is approaching its peak and there is a need to strengthen demand in other areas. On policy, the Reserve Bank of Australia stated that the effects of previous rate cuts have not been fully reflected in the economy. However, it is appropriate for the central bank to lower interest rates further, as this will help to foster sustainable growth in demand and inflation outcomes consistent with the target over time. The easing trend will likely continue through 2013. In the U.S., House Republicans have offered their own counter-proposal to Obama's to avert the so-called fiscal cliff. The proposal would achieve $2.2 trillion of cuts in deficit with a $900 billion cut in Medicare spending. In addition, there would be $800 billion increase in tax revenue through reforms, without raising tax rates. Boehner said in a letter to the White House that the plan is exactly the kind of imperfect, but fair middle ground that allows us to avert the fiscal cliff without hurting the economy and destroying jobs. However, the White House rejected the proposal saying that it does not meet the test of balance. Communications Director Pfeiffer criticized the plan for actually it does lower rates for the wealthy and sticks the middle class with a bill, and middle-class taxes will have to go up to pay for lower rates for millionaires and billionaires. Boston Fed Rose Ingram said, a strong case can be made for the Federal Reserve continuing to purchase the current $85 billion in longer-term securities a month, even after Operation Twist completes at the end of the year. He emphasized that monetary policies designed to lower mortgage rates and stimulate more activity in interest-sensitive sectors have been effective, and are an important reason why the U.S. economy has performed better than many of our developed country peers. On the other hand, St. Louis Fed Bullard pushed for a statement in terms of actual values for both inflation and unemployment, as thresholds for policy accommodation removals. He said that switching to a threshold strategy does not necessarily mean that policy would be easier or tighter. And he noted that 6.5% in unemployment rate is broadly consistent with mainstream analysis of the likely value of the unemployment rate at the time of the first increase in the policy rate. In Europe, European Central Bank Executive Board member Asmussen said that the central bank is ready for the outright monetary transactions program but has not yet conducted any purchases as it hasn't been activated. He noted that the central bank will not encourage or discourage Spain to tap into the program. Meanwhile, Asmussen noted that Portugal is not in a state to use the OMT program yet, as there should be reasonable amounts of bonds with maturities of more than 3 years and the country is essentially dependent on financial assistance. ECB Vice President Constantio said that the combined effect of the measures implemented improved the euro money market conditions in 2012 even though fragmentation still remains high. And a key lesson from the crisis is that we need to better understand and monitor the repo as well as the securities lending markets, given their importance for the efficient functioning of the financial system. Governing Council member Neuer said that expansion in central bank money has not affected inflation expectations, which have remained well anchored. On the data front, Australian current account